Hello and welcome to ETBFSI.com. My name is Amol Dete and you're watching FinTech Diary. In this chapter of FinTech Diary, I have with me Pallavi Shrivastava from Progcap. Pallavi, glad to have you.
Thank you, Amol. It was long pending, so very happy to be here.
Yes, finally, the lady is here. So, Pallavi, tell us about Progcap. Though we know a lot about you and specifically Progcap, it is there in the market since quite some time now. You also have an NBFC license. How big is Progcap? Why did you start Progcap? What is your vision and how is it shaping up? Give us a whole dashboard about Progcap so that our viewers will have a great reference.
So, as you know, we started in 2017 with a very simple idea to address the MSME credit gap.
Right.
Now, this is a segment that is too big for MFIs and too small for the corporate lenders. And we started to figure out how we can really bridge this massive credit gap in the market. Back then, if you look at the numbers, it's about 25 to 30 lakh crores of the demand that's there out there and completely unaddressed back in 2016-17. Where we found the real challenge was not so much on the supply side, but also the demand side, right? So these customers, these MSMEs are used to working in a very different way. They have a purchasing cycle, they have a repayment cycle, and so we wanted to bring credit where the commerce is flowing and bring it as close to their working capital terms, right? So we have on one side you see the manufacturing MSMEs and then the other side is the trading MSMEs.
Yes.
We decided to double down on the trading MSME segment, which is about a third of the 64 million MSMEs that are out there. Typically, they buy from the stock from a wholesaler or a distributor, and then the distributor purchases from the brand. So there is a complete supply chain. The reason I decided to do this was two things. One is, of course, I come from a banking background. My father was a public sector banker throughout his career. So credit conversations were dinner table conversations. Secondly, I was very impacted by how MFIs have solved for the credit need of underserved individuals. But we did not see a scaled up model for SME credit, right? We did see one model which could work for SME credit at scale. And that was the real gap. And when I worked at IFC and World Bank, I started looking at it from a systemic and a policy lens to see why this gaps exists and why the infra is broken when it comes to SME credit. These are thin file customers, they don't have the right kind of data, banks find it very difficult to lend, and the ticket size doesn't make sense to really go till the last mile and then serve for it. The branch networks don't exist. So how do you solve for it digitally and also structurally, where you are also able to not only give money but build risk mitigants in the structure that you're also able to get the repayment behavior and so a large part of the solving is not so much on traditional underwriting. Underwriting using data technology is a big part of it, but it's also capacity building, training these customers on how you pay in time and what kind of incentives you structure in the supply chain that they get into good repayment behavior. So that's the journey. In terms of the scale, we've already done about 40,000 odd crores of the funding in this market. This is in terms of the throughput. Our outstanding, the sort of the sanction limit would be around 4,500 odd crores, and the utilization hovers typically around 65-70% in that range. We've been able to keep the portfolio quality consistent over the last 6-7 years, owing to the structure, the way we bring the brand, distributors, retailers, and the entire ecosystem together on our platform where data and technology really plays a big role.
Noted your points. Pallavi, the immediate question that I have is, in the last couple of years, or specifically 10 years, as digital picked up, technology scaled up, everybody's trying to bridge this gap and everyone actually entered in this space, whether it's SME lending, MSME lending or micro lending, whatever name you can call it. Not from the digital side only, which are the fintech or tech companies, but also the banks became very aggressive. What is unique that you are doing at Progcap? How do you think that you are the best one or the best maybe to bridge this gap from your own domain and expertise side?
So I wouldn't claim the best spot. What I would really claim is that we are fundamentally trying to solve for this gap, right? And moving from, and I think the vision is how UPI created rails for payments, right?
Yes.
We want to create the credit rails for
Yes.
MSMEs, right?
Yes.
And that's a very large ambition, and it would require a lot more players to come in. And it's a very interesting question you asked, that you see so many people talking about SME credit and addressing it. But the moment you just scratch the surface, the reality is much more nuanced.
Right.
You will find that that still the gap persists, and you will find that it's mostly the formal MSMEs, right? If you look at the data of 64, 63 million MSMEs, hardly 10% of them are actually filing for GST.
Yes.
Right? So that's the level of formalization. So it's mostly in tier 1 tier towns where you find that SME credit for more formal SMEs is where the funds are going today.
Right.
I think the real issue really goes the moment you move to tier 2, tier 3, tier 4 towns. And that's where the gap is very large, very persistent. The data gets even more weaker. The realities are very different. And to solve for it is a very different ballgame, because you got to really understand the pain points, the challenges, and how you really structure a product that can really service their needs. So
Yes.
if I look at tier 1 towns or tier 1 of the supply chains, that's where I think there has been a lot of emphasis and a lot of players coming in.
Right.
And I think that journey is moving from, that doesn't need more products. I think what we need is more depth now.
Yes.
Where we go to tier 2, tier 3 towns, and we also go to tier 2, tier 3 supply chains, from a corporate-led supply chain finance perspective. And I think that's still a very large underserved market. When we started out, we used to see about 40% of our customers were new to credit.
Okay.
And I had personally visited so many shops, and they would say credit card bhi nahi hai. Now today, that number is going down. So we are finding that change definitely in the last 7 years.
So a lot of people came under the radar of credit and system.
I think we still can't say that this problem has been solved.
Absolutely.
Now coming to the question of how we are looking at ourselves, of course, like I said, we want to build the rails for solving for MSME credit at scale. That's one broad, large ambition that we all hold together as an industry as well. But I think the differentiation lies in the way we go deeper into the supply chain. So our moat and the model is starting with a corporate, where we work together with let's say a large anchor, and we will go down their supply chains to create this right kind of product, understanding their trade terms. The second part of it is it also allows us to get access to data, right?
Yes.
So we leverage a lot on the ERP data. While we now have the account aggregator framework, we have the UPI payments data.
Yes.
But this ERP data allows us to a very large degree create a proxy for how a customer would behave on a formal credit.
Right.
So we do a pre-qualification and then also tap into the other data sources which are available to all. So that's been a second big lever. The third for us is really the risk mitigants, right? So by virtue of working with a corporate and integrating into their supply chains, we are able to keep everyone honest, right, in terms of how the money flows, how the repayments happen, and build risk mitigants at all levels. The vision and the process is that how you can create the right incentives, and not change anything more on the trade terms, while actually sweetening the value proposition for each entity in the process, right? And so that's helped us to really be able to scale up and keep the portfolio healthy as well.
Yeah. Sure. So you came from a interesting banking background where the credit conversation happened at home. Then you also got into the banking space. But when you decided to get into the bridging the credit gap and entering into the MSME space, what I really liked about your company, or maybe the profile which everyone would appreciate, is the big investors on board, right? Including Google, not just Sequoia and everyone. How did you convince them, Pallavi?
Yeah, good question. So initially, see, when we started, the model was, this was a complete white space, right? And if I can do a shameless plug here a little bit, we actually see ourselves as having created this category in some ways. So, in order to convince the first, customer or a first corporate to say that this can work, and then going to an investor and telling them that this is a model on paper and we're trying to make this work, it was really difficult for them to believe. While it sounded good on paper, but the idea was how will you really build it and scale up, right? Having said that, from the day one, we saw a lot of conviction from the investor community, and there was a good sort of push to say how just scale it up, and we would like to then invest. So we never really went out to look for investment. A lot of it was inbound. At later stages, in the early stage, we had to do a lot of convincing. We would have met about 50, 60 investors to finally get the first, Mirac Ventures, GoEx come on board, and then Sequoia came on, and then the rest was followed suit. So,
Understood.
So I think it's good to have a good names on the cap table. At the same time, I think that it's the real execution and the rigor and how you really implement and try to stay the course is where what matters more. And we would like to be known for that, in the long run, compared to who's on the cap table.
So since 2017, Pallavi, now again, there are so many companies operating in this space. Maybe in 2017, perhaps the numbers were less. Every second fintech is operating in the similar space that you are. Few of them are with maybe working as a lead generator just for banks or NBFCs, or some of them also have an NBFC license, right? And they're quite aggressive about it. How did you see the whole market changed in last 7 years specifically for you? And what kind of major developments that you think will drive this particular segment going ahead?
So broadly, if I can just classify, I'm seeing 2 to 3, broad shifts that are happening. The first shift is more around moving from distribution to infra, where now, like I was speaking at the panel yesterday and I shared this, that we talk about embedded credit, but it's mostly a cosmetic element where you just add a checkout financing as an option. So it becomes more distribution. But the real embedding will happen when you start to put intelligence into this, right?
Yes.
And you build, use the data to get feedback loops and keep on making the algorithms more intelligent and keep throwing it back to the entities involved, right? And I think that's the change where people are now saying that we've gone through this blitz scaling phase, and so it's more now seeing how we can build a long scale, more than just acquisition of customers, how we can sustain and build for the long run.
Right.
That's one. Number two is where we are seeing the huge focus on profitability, unit economics, and compliances, doing the right thing from a customer point of view. And so it's no longer about cheap equity or blitz scaling and those pressures. It's more building a now solid business, right? So that's the direction which the ecosystem is taking.
So on the business front only, how do you ensure that your margins are protected? How do you ensure that the whole gap between the fund raised and the fund disbursed is being maintained? What kind of strategies have you adopted so that this balance will be maintained, specifically for the underwriting part, Pallavi?
In our business, the way we look at it is from the very important metric that we drive is risk-adjusted yield.
Yes.
So it's if you look at the nature of our business, you will find that there are thousands of invoices every day that are getting processed, right? The sheer velocity of it is so high that there's a very high energy, and you can confuse that velocity for scale.
Yes.
And the focus for us is now shifting from saying not just the AUM growth and scale, but profitable and sustainable growth, right? And what that means is that you need to keep razor sharp focus on the risk, your credit costs, how you build the early warning systems, so that you are able to address any errant behavior at the right time.
Right.
So I often say this internally that we are into monitoring business because once you've given out the money, we can't just wait for the EMI to hit and then see,
Yes.
where the bounces happen. For us, it's every day you got to be really monitoring every single invoice and the behavior, because the repayments happen on a regular basis. So that's where we want to keep the credit cost low, and that's a paramount. That's
Yeah.
one metric which we constantly measure. The second one is on the cost of funds, right? So that's where we get the leverage. We're now work heavily this year on the debt franchising.
Right.
So now we're hit the capital market. So we have listed NCDs, we have banks, NBFCs, and just keeping this credit cost low has also allowed us to access capital at a good, decent cost. So that's been the other lever, and just the balancing act of these two. And then the third element is the operating cost, right? Which is where I think we start to see the moment we hit economies of scale. So these three balancing together is what leads to having the profitable. We cannot overcharge our customers, because
Exactly.
it's very hard for us to keep increasing the rates. You've got to build the trust and show
Noted.
that kind of an impact on the ground as well.
Absolutely. But Pallavi, the question is, you being an NBFC, you are not have a great exposure of raising funds. You have your own limitations. Of course, NBFCs can also raise capital quite seamlessly, no doubt about it. But what I want to understand is there is a limit to the cost of capital, right? You're going to raise it from certain institutions, certain investors. So the cost of capital is going to have one benchmark or one metrics followed by the investors. How do you ensure your cost of capital is low? Because then you have to maintain your lending rates as well.
Yeah, so the way to do this is, it's a playbook which is,
Yes.
you eventually, move. We are in the end, once the demand side is sorted, and there is a huge demand out there. It's mostly, how you really build the supply side of the story, right? And how you. So it has to be a mix of long-term versus short-term debt. Diversified, base of lenders. So your banks, NBFCs, private sector, public sector, banks,
Right.
so that's one side. And then what kind of product spread you have, right?
Yes.
So for us, short-term WCDLs, CPs make a lot of sense because of the short-term nature of our lending. And then what kind of tenors you have, across the products suite that you are borrowing.
Right.
And eventually, we are now diversifying into external commercial borrowings, and then tapping into the capital markets, and then tapping into the foreign lenders, right?
Yeah.
So the way, and we recently we are the first ones in the industry to do a PTC transaction, the pass-through certificate on dealer finance portfolio, which has gone quite well for us. So these are the broad levers, and I would say that we are at a perfection point. We are just a 3-year-old NBFC, but we've been able to really slowly, gradually build this in a solid, franchisee, and also at the same time making sure that the risk and the cost of credit, continues to remain under control. So anywhere between 1.5%, sub 1.5% is where we are drawing the line, and then those are some of the levers that help us to pitch to the lenders. Our rating keeps on improving year after year. So that's a journey. I think we'll see how this pans out at a much larger scale.
One more question specifically on the business before we move on to the FinTech as a whole. How's the whole business shaping up for you? You partly mentioned in your first part, but how many loans are you disbursing every day? What's your margin size, if you could be specific and tell us about it? And what kind of AUM do you have today? And what is your long-term vision on that? If you could share some of the details here, Pallavi.
So we disburse roughly around 800 to 1,000 crores on a monthly basis. Now, when I say disbursal, that is not the AUM, that's the velocity of
the loans,
right? Typically, this is across tens of thousands of MSMEs, right? So we would onboard roughly around 1,000 new borrowers, 800 to 1,000 new borrowers on a month-on-month basis. The way we measure it is on the sanction limit. So you will sanction a certain amount, and then depending, because it's a seasonal nature to these supply chains, the utilization will vary, right?
Yes.
So maybe it's a summer season, then the summer products like air conditioners or your FMCG industry.
Capital goods generally, largely.
So those are the
Yes.
industries that pick up. When you reach the fag end of the year, that's when you see two-wheeler industry
Yes.
picking up.
Yes.
Around Diwali time, we do the maximum business. So there's a huge seasonality and
Yes.
therefore variation in the business. The way we look at it is that we need to have brands for all season
Yes.
and have a good mix so that the AUM does not drop drastically. So there we are now in a phase where we have a very good diversified bouquet of industries and segments that we work across. Within that, now when we acquire a customer through a supply chain using a revolving credit line product, we then offer them slowly a term loan, right? So that's the other product that we have offered. We've also recently got the factoring license. So this is how but our acquisition engine remains to be the corporate distributor-led supply chain.
Right.
And then once the customer matures, that's when we try and see how they behaved on this loan and with us, and then try to cross-sell other products.
So has your cost of customer acquisition come down?
It has come down significantly over the last 3-4 years. But we do see that there is a huge scope for us, because the last 2-3 years, if you see, the consumption hasn't picked up as well, right? And then there were other impacts on the economy in terms of the regulatory environment. The digital lending guidelines have now shaped up well. So we started, and if you know the journey, Amol, we started with being a platform, then moved to own book, and then co-lending structure. So those impacts also came on the phase and scale of the growth journey that we had over the last 3 years. But now we see that as the demand is picking up with GST2 impact, we are quite confident that this should go down further over the next 2 to 3 years and then stabilize at some point.
Sure. Now let me just take 1 or 2 questions specifically on the fintech industry, fintech sector specifically. How do you see the whole fintech sector today, Pallavi? What kind of developments are you seeing? Couple of fintechs have already got listed. Many of them are planning to list. Couple of fintechs are also struggling to raise funds. Couple of fintechs are also complaining about the whole compliance and the risk, which has increased or in multifolds. How do you see the whole fintech ecosystem of India right now?
It's at a very interesting and inflection point. I think we saw between 2016 to 20, we saw that there was a large number of fintechs mushrooming. We had a full payments run, and then the lending fintechs and MSME space, consumer lending. I think we have reached a point where we are moving towards institutionalization and some bit of consolidation also, if I may say, wherein now many of them either have gone the IPO path. Many of them are now looking to file for an IPO, and many are actually seeing how we can really partner with others and collaborate and scale up, and so all sorts of things are happening. I think it's a very interesting inflection point for us to see how this will shape up over the next 2 to 3 years, right? The way I look at it, that all the fintechs or companies which have really built with the right risk model, right governance, compliances, and solving the real hard problems at scale, and building that into the DNA, the mindset of building profitable, risk balanced growth. I think those are the ones which are really will have a great run over the next 5 years to 10 years. But this timing is because from the regulatory side, it's very clear, right? It's the digital lending guidelines have come in, the co-lending guidelines are there. So the market is kind of now well stabilized. We know what is right, what is not, barring a very few gray areas which we are still kind of solving for as an industry ecosystem. So this is a timing where I believe that we'll see in the next 2 to 3 years what stays, who stays, what what happens to the ones that have truly scaled up. But quite
there is a lot of action.
And the other thing which I find very unique in our country is this whole co-lending, banks working with fintechs, LSPs. There's a very clear definition which also allows us to really collaborate. Personally, for me, it will be very interesting to see how all of this comes together to solve for MSME credit,
Yes,
right? And
yes.
there's no real categorization of MSME, uh, you know, industry as a product for
Yes.
MSME. Everything gets wrapped under the consumer lending,
Absolutely.
So I think that will be a big shift.
Yeah. No, sure. So, no, so that comes to my last question specifically. Since industry is changing, everybody is heading towards IPO. So immediate question to you is also, what's your next plan? When are you going to hit the IPO market, and how are you thinking about it?
So step by step, you got to first build the the demand engine, then the supply engine, then look at profitability, look at risk adjusted yield, build that mindset and culture internally, and then comes the governance and compliance, right? So and it actually, I wouldn't say it comes at the end, but then that's it has to be a consistent thread running, but making sure that all of these pieces are moving together well, and that's when you can say you are truly ready, right? So we've already crossed a lot of hurdles. We've been through the cycles of co-lending getting impacted. We've worked with small finance banks and co-lending structures. So it's been an interesting run. The way I see it, maybe it should be about 2 to 2.5 years where we are truly at a stage where we can think about, from a very internal confidence perspective and also the scale perspective. More importantly, I think, whether you go public, whether it's just the funds that you need to serve the borrowers that you have, the impact that you are creating on the ground. And I think that's what matters. And if we continue to be true to that purpose, I think all of rest, everything will fall into place.
No, I mean, 2 to 2.5 years kind of deadline that you're saying is okay. I mean, that sounds meaningful, but don't you think that you should hurry up because the rally is there right now? Come on, you should, right?
Thank you for that confidence. I hope our teams will be listening to it.
Good. Last point, where do you see Progcap maybe in next 2 to 3 years? What is your vision, apart from the listed part that we just discussed?
Many things, we are, one, of course, we want to keep doubling down on this ecosystem, right? It's hard. It's a real hard problem to solve. It takes a lot out of us, but I think we want to continue being true to that mission, the vision, the purpose that we started out with. So that's something where we don't want to lose focus on, and that means that we now open up more industries, go deeper, both in terms of geographical depth and also in terms of the depth of within the segments we operate in, right? So we are no longer chasing width, but actually going deeper and seeing how we keep becoming more and more relevant to not only the MSME customer, but also the client, the entire supply chain that they are a part of, right? So that's one side of the story. The other is we are also trying to really figure out how we can, use some of the new generation tools. Like we recently launched a product on the which is called as Progcap, which works very deeply embedded into the supply chains of corporates, and then through that we are able to integrate into the ERPs, have real-time visibility and underwriting and everything built into the supply chains, and then effectively credit happens at the point of commerce, right? So that's where we are doubling down on putting our minds together on how that can be a very big and a scaled up aspect. The third is partnerships, right? So opening up a lot of more anchor partnerships, and seeing what more is out there, not only in terms of credit opportunity, but also a byproduct of credit. The way we do it is also digitization, right? So that's where we see a huge demand and opportunity coming up our way, which is what we're building for. And finally, like I said, the supply franchisee, and making sure that we have a broad pool of debt options, and then co-lending has been an important aspect, but it's going to be important lever for us as we scale along. Work with private sector banks and public sector banks, and do some bit of lending with those partners as well. So that's the 2 to 3 year playbook. If nothing changes in the broader ecosystem, I think we are pretty much in a very solid state to execute that plan.
Sure. All the best on that note, and thank you so much for sharing your meaningful thoughts on this chapter of FinTech Diary, Pallavi.
Thank you so much for having me, Amol. Thanks.
Thank you, and thank you so much for watching this chapter. Thank you.